Hello everybody, this is Books of the Stock Market. How is everyone doing? As for me, everything is fine. It is super hot and running in the morning is a pain. Anyways, in this week's video, we'll be talking about the Wyckoff's distribution. With Bitcoin making an unexpected drop to the downside during the middle of the bull cycle phase, many people started to bring up Wyckoff's distribution. I have never heard of this, so I thought I might as well read about it. As I was reading about it, I also learned about other stuff Wyckoff taught, so I decided to make a whole video on Wyckoff. Before we begin, we should probably learn a little about Wyckoff. Richard DeMille Wyckoff was born in 1873 and he got into the stock market at a very early age of 15. By the time he was in his 20s, he started his own firm and was also the editor of the magazine of Wall Street. Wyckoff also studied famous traders of his time such as J.P. Morgan. He eventually became one of the titans of technical analysis. However, he did not keep his secrets alone. He noticed that retail traders were getting burned left and right, so he started his own school, which eventually became the Stock Market Institute. He emphasized trading like the big traders so much that he defined a perfect trader. He called this perfect trader a composite man. He stated that the composite man should plan and execute his trades carefully. The composite man should also try to convince other people to buy a stock in which he has a sizable position in. This can be done by constantly buying shares day after day to make it look like the broad market is getting into the trade. The composite man must also study an individual stock chart to see how it reacts to the environment and also how the major holders of the stock manipulate the price. As you can see, he really emphasized that retail traders should try to act like institutional investors so they don't get burned. Now we know a little bit about Wyckoff. Let's look into the Wyckoff's price cycle. His price cycle is based on 3 laws. The first law is the law of supply and demand. He states that the law of supply and demand determines the price direction. For instance, when demand is greater than supply, price rises, while when the supply is greater than demand, price falls. The second law is the law of cause and effect. This law allows the trader to set price objectives by reading the horizontal point count in a point and figure chart. The final law is called the law of effort. This law states that when divergences between volume and price occur, then there's a change in the direction of the trend. When these changes and trends occur, then price effectively enters a trading range. Trading ranges start when the current trend has ended and price has entered a certain consolidation phase since supply and demand has somewhat come to an equilibrium. When this occurs, we enter the accumulation and distribution phase. The accumulation phase is when institutional traders prepare for the next bull run since the bear run has just ended. On the other hand, the distribution phase is when institutional investors will sell their shares as they are preparing for the upcoming bear market. Wyckoff therefore states that the composite man would actively buy during the accumulation phase and sell during the distribution phase to match the institutional investors. To explain this more carefully, let's look at the accumulation and distribution phases. But for now, let's first start off with the accumulation phase. In this first image, we see that we have fallen from a higher price point as the current uptrend ended. From here, this is when the accumulation phase starts. PS stands for preliminary support. This is where substantial buying begins, which causes an area of support. At this point, you would usually see a volume increase as price range increases. Finally, this is when price hints selling is coming soon to an end. SC stands for selling climax, and this is when there's a lot of panic selling by the public. Institutional investors, on the other hand, are coming in to buy the stocks that were panic sold by the public. The AR region is called the automatic rally, and this is when the selling pressure has diminished, causing prices to go up as buying increases. This peak will define the upper boundary of the trading range. As for ST stands for secondary test, and this is where you retest the support line the selling climax has made. You should see a bounce off this level to confirm that the bottom is in. The spring stands for a time where institutional investors intentionally lower the price below support lines to cause retail traders to panic sell more. This is when the institutional investors will come in and add shares to their positions. There is another shakeout called the terminal shakeout, and this occurs at the end of the accumulation phase so they can get even more long positions before exiting for the bull cycle. Once we go towards the second half of the accumulation phase, we will usually run into multiple tests where institutional investors test the supply. If there's a lot of supply, then the market is not ready to go up, and this means that price will fall and another spring may occur. However, when there's not a lot of supply, meaning that people are readily buying the available shares, we should see the move towards the upside. SOS stands for a sign of strength, and this is when price spread and volume both increase at the same time. The LPS stands for the last point of support, and this is when the resistance has become the area of support. It is important to hold this level as a support level since it was once a strong resistance level. Also, you can see some profit taking here. BU or backup is another way to say the last point of support. After the BU phase, we usually exit the accumulation phase and we rise to new heights as all people involved have accumulated successfully. With the accumulation phase out of the way, let's look at the distribution phase. The first part of the distribution phase is the PSY. The preliminary supply is when the big players want to unload their shares after an up move. This usually causes more volume and price spreads to increase as more shares are flooded into the market. After the PSY stage, we are usually hit with the BC stage, which stands for the buying climax. This is the opposite of the selling climax, and this is when the public has bought the shares that the hedge funds just unloaded. This move upwards is usually caused by some sort of good news or good earnings call. After this is the AR phase, which stands for the automatic reaction. This is when intense buying dies down and we seem to find some sort of support. This low can be used as the lower boundary of the distribution trading range. After that, we see the ST phase start, which stands for the secondary test. This is when price tries to retest the area of the buying climax to see if the top is confirmed. The top is when the supply is greater than demand, which means that price will continue to fall. There are times when the UT happens, which stands for upthrust. This is when we see price move above the buying climax during the day but immediately close under it. Since we just confirmed the top is in, we usually see an SOW event. SOW stands for a sign of weakness, and this is when we usually move past the automatic reaction and make a new low. This can indicate that there is more supply than demand and we have officially entered a downtrend. After that, we usually hit the UTAD, which stands for upthrust after distribution. This is the opposite of the spring and terminal shakeout, and this is when price tests new highs after breaking out of a buying climax resistance level. Usually, this is short-lived as supply is still the dominant player here. From here, we usually enter the LPSY area. This is the last point of supply, and this is a series of small rallies that show that the market is having trouble going up. Since buying pressure is really low and there's a lot of supply, the stock is exhausted, and this is when we make new lows as the stock gives up. And this is where the content ends for this video. In this video, we went over some of Wyckoff's teachings and distribution phases. My next video will go into more details about the distribution phases and accumulation phases. We will also be looking at Bitcoin directly to see if Bitcoin is in an accumulation phase or a distribution phase. But before I end this video, I thought I should make a portfolio update. Let's first look at Bitcoin. We see that Bitcoin had an 11% update. I added $609 into Bitcoin when Bitcoin was trading at $37,565 mark. So far, we're at the $39,000 level and seem to be trying to test the $40,000 range. Hopefully we break out of it this time. Ethereum also had an 8% update. I didn't add to this position or anything, but it looked like it rose mainly due to Bitcoin having an 11% update. Here we have Litecoin and we also had an 8% day. Once again, I didn't change this position, and like Ethereum, it looks like we're only up this much because Bitcoin had a great day. Well, that's it for me. If you liked this video, press the like button. If you have any questions about this video, leave a comment below. If you want to watch more videos like this, press the subscribe button. This is Books of the Stock Market, and I'll see everyone next week. Thanks.